Okay, good morning, everybody. It's Thursday again, and time for our weekly Q&A call with one of our analysts. This week we're going to be chatting to Fisakuhle Mbutu. He's going to be telling us about Redefine and their update, and then we're going to take your questions. You're welcome to type them in the chat as we go along, or you can ask them outright by switching on your mic. I see there's already a question in the chat, which we'll deal with when we start with that. But first, it's going to be Fisa updating us on the note that is published on Redefine, and then Sean's going to do a technical bit, and then we'll open the floor for questions. Thank you for joining us, and thank you for informing us, Fiso.
Thank you, Sarl. Good morning, everyone. My name is Fisakuhle Mbutu, and today I'll be taking you through some of the highlights from our Redefine company update report. So just on the summary side of things, we still maintain our buy recommendation with an intrinsic value of 547 and a 27% upside. We haven't materially changed our view on Redefine as a whole, mainly because we still do expect some further outperformance there, driven by continual yield level depression. We would have seen that they've come down from as high as just over 12% to about just under 11%. We think there should be a continuation of that compression, catalyzed more by the interest rate cutting cycle we've entered into, and more so improving demand dynamics in the likes of retail and industrial. And even though we do still remain optimistic on Redefine as a whole, we do highlight the risks around its office exposure, given that it's about 34% of that South African exposure by value. And even though we categorize it as a risk, we have impacted some scenarios into our valuation that does, in the grander scheme, still skew the risk to the upside for Redefine, but I'll get to that on the valuation section. In terms of things that will change our minds, those 2 points haven't changed. The first one is more so a deterioration in property fundamentals, particularly in the demand aspects. So that would speak a lot to the vacancies as well as the rental reversions. And then the other one would be more so an outlook change to government bond yields increasing and having a negative impact on property performance, given the directional relationship that they have with each other. So on the office side, particularly because there hasn't been a lot of material news since the last company update report, which would have been in November, this is more a reiteration of the risk that Redefine is exposed to through the office spaces. Again, seems like the vacancies are more concentrated, one, in the secondary and A-grade spaces that you would see on the chart on the left, and then two, more so in the Gauteng region. So what we have done is flex our valuation to take into consideration a couple of scenarios, most of them leading directly to a decreased exposure in office by Redefine, where we would see the secondary and some of that A-grade space being disposed of strategically due to some underperformance. And some of those scenarios would include the likes of being unable to convert some of that office space into residential space, either it being too costly to convert some of the existing office spaces into the smaller, more in demand kind of office spaces. And the other one just more so being some head offices moving to the outer regions such as KZN and Western Cape, impacting the kind of exposure they have in the office space as well as in Gauteng as well. And even though we think that is a possibility, we think that the likelihood of it happening is less so than the likelihood of it not. And this is why we have put that bear case scenario at about 20% and then the bull case at about 30% as well, just to highlight the risk and how in the grander scheme it is still skewed to the positive side. Then I've shown these charts before, and I'll just show them again because what they do is on the right-hand side, sort of reiterate that property overall in the last 8 or so months has been the place to be, as we've seen in the SAPI just outperforming that JSE All Share, and Redefine has lagged a little bit when compared to its index on the SAPI there, but overall still doing better when compared to the All Share. And then that chart on the left really more so highlighting that directional relationship between bond yield movements as well as the price to funds from operations multiple. We do expect it to to increase a little bit as high as about 15 times as we've seen in our bear case, and it could go as low as about 9 times we see in our as low as 9 times that we see in our bear case. But overall, we still see a skew on the upside given the kind of quality property company that Redefine is, over and above the exposure that they have in office. So just brings us more to that talking point around why we would expect a little bit more outperformance there. One from a economic side, and the other one more so from a company specific side. So all this chart does, it just looks at, as we've seen, the core and headline inflation being within that SARS band, which is giving us some positive confidence around expecting some continued cuts, which should have a positive impact on the bond yields and ultimately a positive impact on property performance as a whole as well. So on the valuation side, we still maintain that buy recommendation with that IV of about R5.47, an upside of about 27%. And as you would see in the bear side as well, as I've mentioned, we have flexed it back quite a bit to have a scenario where they have decreased their office exposure materially, and it would end up seeing about a 19% downside there. But again, we see the likelihood of that happening a little bit lower than not, which is why we have that scenario at about 20%, with the bull being at 30% overall, and we still see that that upside of 27% as likely. What we do expect, if the office space remains stagnant and the retail and industrial continues to perform as they do, it should have a small impact on that funds from operations margins, with about a 5 to 23 basis points decrease, but overall still positioning Redefine as having some upside potential over the longer term, given the kind of quality company that it is from a property perspective. So yeah, that's it from my side. I'll just hand over to Sean to speak a little bit about the technicals.
Yeah, good morning, everybody. Yeah, you can see the chart there of Redefine. This is until yesterday's close again. Yeah, it's trading below always moving averages, below its 20, its 50-day, and its 200-day moving averages. So the medium-term and the long-term trends remain bearish. Saying that, also the share price has been moving sideways in a trendless market since September last year. And at the moment, it's trading quite near to that critical support level, around about the 420 level. Should that support level not hold, we could expect the share price to pull back towards around about the 350 level. That's right at the bottom there. I don't think it will do that, but on the upside, the share price, it needs to break up above all those moving averages. So those moving averages will act as some resistance. And obviously, there's also some other resistance lines that will obviously need to be triggered to give a change in trend to bullish. You can see also at the bottom here, the MACD indicator. It is trading in oversold territory, and it's just below its trigger line. So no clear bullish signals yet. But I would say I can see it now at the moment. It's around about 1% down today, trading at 432. So at current levels, the share does offer a bullish opportunity, and as Fizo said, now the intrinsic value is at 547. So hence our buy recommendation. So there is upside potential at these levels. That's how I see it. Thank you.
Thank you very much, Sean. I'm going to start the Q&A, guys, dealing with the question that we got in the chat there. And I saw Kobus was trying to get back in. Yes, I see he's on. Okay, so I'm going to deal with his question. And Kobus says, in April 2024, you had a discussion on Redefine and Richmond, right? Suggesting a decline in CFR, Richmond, and growth in Redefine. CFR is now up from 2760 to 3405, and Redefine barely moved. Are there any reasons why this happened, right, or did not materialize, and what we could learn from this? Okay, Kobus, let me explain to you the process that we go through. You know, the financial services industry is a highly regulated industry, and we do stuff mostly according to the rules. Inside of the firms, where we manage client money, we've got a set of rules that govern how we manage portfolios. Within that set of rules, we don't allow for one guy to just run in and say, well, he thinks this is a good buy, and then the whole portfolio gets realigned. I mean, we've got a set of rules there that govern how we think and how we should do analysis on that basis. So this analysis that we do here, we do with the view of possible inclusion into a portfolio, right? So we've got a set of rules and an evaluation method that's predetermined. And that's what these analysts do for us. So they evaluate the company income, they evaluate the outlook, the macroeconomic outlook, combine all of that and form a view of what they think could happen to these companies. At the time when they did the analysis, there was probably a set of information in front of them, which made them say what they did. Right? In the case of Richmond, we saw the stock run hard after they produced some fairly good results. Their results came despite their peers like LVMH and them being down, and Richmond all of a sudden being up. Richmond was down in China, but Richmond made quite a bit of money in Europe, Japan, and America, and specifically in their jewelry business. Their watch business was down, but the jewelry business made for the larger part of the gain. So it could be something as simple as that, in that there's a new trend developing. People are buying jewelry. Richmond has the products that are in favor at the time, and the market is going slightly better. So the market for luxury goods improves, not necessarily on the specialized watch side of things, but on the jewelry side of things, and delivers a spectacular set of results for Richmond. At the time when we evaluated it and said, well, we think there's actually potential for the thing to come down a little bit lower or have a hold recommendation. I can't remember what the exact call was. We based it on the facts that we had on the table when we did the recommendation. Redefine, obviously, we've liked because according to our valuation method, it is undervalued. And there's a couple of interesting things that may happen to two places like Redefine and these property stocks. Just this week, Mr. Trump was sworn in. And one of the things he immediately did is he said, all federal workers back to the office. Now, we've slowly seen a trend in the US of companies ordering people back to the office. We've seen companies like Walmart, Disney, UPS, all saying that they're going to order people back to the office. Amazon and AT&T are going to do it, and JP Morgan in the financial side of things is going to work from office 5 days a week, starting beginning of March. That may kick off a global trend of companies deciding, listen, there's no pandemic on the horizon. Work from home is actually, in our view, not working out the way we're thinking it should. And people start ordering people back to the office, and all of a sudden the property market, and especially the office sector, will improve, and a company like Redefine may or may not rally. But those are the types of facts that we consider when we do this analysis, over and above the fundamentals that are on the table, and simply just crunching the numbers to say, this is the profit they made, this is how many shares there are, this is the valuation. So we do take into account quite a bit of stuff. Fisa, do you want to add to that?
Yeah, the other thing that's important to add is context. So it's a nice thing that Pierre put in the chat as well, that for most of the parts, the call was all right, because we did expect the property sector to perform quite well from the beginning of Jan last year up until the end, and it did for quite some time. And the context around the Richmond call was based on fundamentals. And if you would look at sort of the following 4 to 5 months after the call, it was in general correct. And if you're looking at the last 12 months, the real kicker that we saw from Richmond has actually been in about the last 2 or so weeks. So that kind of context is important. And the reason why we had that initial call and the view hasn't materially changed is particularly around strength around China. Because if you look at the last decade, specifically in that luxury sector, China has been the bigger growth driver. And we would have seen that we entered into COVID, it started becoming more of a detractor. And when they were going more into a recovery, it was recovering slower than usual. I think the important thing here to realize is that even though our view on China hasn't changed, what has happened is that when you look at China as a contributor to Asia Pacific, it's gotten a little bit smaller because some of the Asia Pacific some of the countries in the Asia Pacific region have done a little bit better than China. We've seen a little bit of strengthening out of the US consumers, specifically because those households participate a lot in the market, and the market has done quite well. They also travel to Europe, and the performance of Europe, particularly in Richmond, has been supported by a little bit of the domestic demand, but in large part by the American tourists going to Europe to purchase Richmond products. So even though at this point in time, as of today, Richmond has jumped quite a bit relative to what we viewed it as valued at, the context there is that it's only been in the last 2 or so weeks. And as you would have seen, the whole market was surprised, mostly because even though China is still in a recovery, still slower than anticipated, it's really more so the other regions that really put Richmond at the top there. And as you would have heard, Sarah, we do keep an eye on those two segments in Richmond, the jewelry segment as well as the watches. The watches hasn't been doing quite well over the last year and a bit, and it's not specifically a Richmond issue. It's more of a sector issue overall, and the jewelry has just been keeping them afloat, mostly because it's a lot more exposed to the jewelry side. So yes, in the greater context, that call hasn't been particularly right, but however, in a good portion of the last year, it has been, as you would have seen in about halfway through the year last year. On a year to date, it was down up until in the last 2 weeks. So yes, we do take that feedback. In terms of the lessons we would have learned, there is more contextualizing some of the regions a little bit better, thinking about all the aspects around the consumer that would make us a little bit less pessimistic, but overall a view on Richmond as it stands hasn't changed up until we release a note that says otherwise.
Thanks, Fiso. I hope that answers your question, Cobus. It's quite an extensive answer to a very good question. Thank you very much.
Yeah, thank you for the question.
I'm going to jump straight to the next one, which says, Mohammed says, can you explain the relationship between the bond yields and performance? In other words, how do the bond yields affect the performance of these rates?
Okay, so the important part first to realize here is that when it comes to the property, guys, there's really a handful of costs that we need to take into consideration. One of them is the municipal costs, which are easily forecastable, and then the other one is really those finance costs, which were a big issue. So what we would have seen in the last, call it 5 years, is that big uptick in interest rates, which means they're having a lot of pressure on the funds from operations / their earnings, which means their ability to pay their investors dividends actually starts to decline. And a large majority of individuals that do invest in the property sector specifically invest for their ability to pay out those current dividends. And that's really where the relationship starts to come in. It's actually isolated more in the finance costs and the impact thereof. As you would see, the increase in interest rates does have a material impact on the bond yields and vice versa as well. Really, the thing to focus on there and why that relationship exists is particularly on the interest costs on their finances and how much pressure it puts on their ability to pay out dividends. And that a lot of the people that invest in these property companies specifically invest to receive those dividends. So that's really where the relationship is. It's more on how much the ability to pay those dividends improves or deteriorates, and that's particularly determined by your interest costs on the bottom of that income statement, and that's really where the relationship is.
Thanks, Fiso. The next question, it ties in. Let's other thing I was thinking about when we answered Cobus, when we recommend stuff and do this analysis and give you a view of what we think you should be doing, bear in mind that we're doing that in respect of a diversified portfolio. I mean, we have multiple stocks and not just the one stock. I mean, this is not a singular stock punt when we say that we think Redefine is a buy and it can go up to 5 odd rand and there's quite a bit of runway there. Yes, it can. And if you put that into context, into the context of having a couple of shares in the portfolio, which then balances out, then the risk is not that much if Redefine does, for instance, not perform, or something like Richmond takes off and you didn't buy it because we said there was a hold recommendation on it. So it's important to always try and diversify across different shares, and it ties into the question that Rajesh is asking. He's saying, what sector do we think will do well in 2025? And that is a very hard question, Rajesh, because we've got a couple of things happening in South Africa in that there's we saw the issue around Mittal or Oslo and the steel factories that are closing down. That'll impact construction. It'll impact the president's idea of getting 4 trillion rands worth of infrastructure going. There's always, with the stuff going on around the world and Donald Trump imposing tariffs on everybody, the US is our second biggest trading partner, and that might put some inflationary pressures on us, and we'll see lower interest rates come slower. We all anticipated the rates to fall fast sort of in the beginning of last year, and now all of a sudden it's come to a halt, even though the inflation is still looking good. It looks like the next cut may be small, and the cut thereafter may be delayed a little bit. So very hard to call what sector will perform well. I suppose if rates are not going to drop fast, then the financial sector will benefit from it. I see Mari says, ShopRite, is it still a buy or do we still wait? So we don't want to go into that note. I mean, our last ShopRite note, I think, said it was a buy recommendation. And the stock's pretty much around the 290 level, which makes it sort of unchanged, if I recall correctly.
Sorry to interject.
Sorry, you say?
The last company update report we had for ShopRite would have been last year in October. And we had a hold recommendation.
Okay, all right. Well, from October to now, the share price hasn't moved much. I think it may be 3 or 4 rand lower than where it was at that time. I mean, we've obviously got a hold recommendation because according to our valuation methods, it may be slightly expensive or it may be fairly valued. One has to bear in mind that ShopRite is the people's choice as far as grocer is concerned, and they will always do well. I mean, they've got the market sort of captured, and we know that with the problems at Pick n Pay, I don't think Boxer is going to be the saving grace necessarily, and ShopRite should definitely be considered as one of the retailers that has to be considered for inclusion in a portfolio. If that answers your question, Marie. Mohammed then further says, you see RDF's office portfolio as risky. What percentage is office to industrial and retail? And has Redefine got a plan to minimize the office risk?
Yes, so I have an answer to that question. So we view office overall as a risky property segment to be in. But we view Redefine's specific exposure as a little bit less riskier, more so because just over 90% of the office exposure is specifically in the higher grade, and so it's in the premium and A grade office spaces, which have slightly less vacancies overall, as you would have seen in one of the charts that I showed. In terms of the exposure of retail and industrial, so retail is about 45% of the South African portfolio, and industrial is about 20% of the South African portfolio. Redefine has been nice enough to us to progressively give us updates on their strategic disposal of underperforming assets, not only just in the office space, but in all of the portfolios in the industrial and in the retail as well. Again, so we do still see the office sector overall as risky, but on Redefine's side, it's a little bit less risky, particularly because of the kind of office exposure they have. So even if we do flex our valuation, as you would have seen in the report as well, on the bear side, we do see some potential downside baked into Redefine. But overall, in the grander scheme, when we consider all of the weighted options, particularly the base and the bull case, we do still see some potential upside. So the downside risk is a little bit less when compared to the potential upside on Redefine as a whole, particularly because of the kind of office space they have. Even though we still view office overall as a riskier place to be in. And all of the diversified property guys have some material exposure in office, but it's all in varying degrees because it depends on the kind of office exposure you have, whether it's PA or secondary grade.
Yeah, it's like I said, there's a risk around the office space, but there's also a risk that things change rapidly, yes, based on external factors. I see Ross has added for us here, yes, definitely a hold with an intrinsic value of 261 on ShopRite, as per the previous report. So the stock's trading slightly higher than that. Mari, I think if you want to buy a ShopRite, then wait for the disappointment around the interest rate announcement next week. And then you'll probably see stocks like ShopRite and that pull back a little bit, and then you can have a nibble. Gert's asking a question, what percentage should Redefine be of a total balanced share portfolio? Now, that's a very difficult question to answer, Gert, because it's a question of horses for courses. There are different portfolio models in which you can construct a portfolio. We see most people taking up the larger percentage of their portfolio is built out of these big, strong, what we call blue chip companies. And then they add a couple of small ones to try and enhance the growth, trying to diversify in that way. But if you do simple math and you say, well, I've got 30 stocks in my portfolio, which kind of makes sense, and I divide that into 100, it leaves me just over 3% per stock. And you give preference to the stocks that you're more certain on that they're going to run, and you say I have a couple of those at 5 or 6%, and you have a bunch down at 2%, then Redefine, I would say, if you're using that methodology, then you could probably go up to about 4% in Redefine. But that's just a thumb suck and really not a recommendation from our side. It's just how I do the simple math from a risk perspective. But like I say, everybody's situation is different, and some people may have more faith in the property sector and hence give a much heavier weighting to the property stocks that they have in their portfolio, whereas another guy might be preferring financials and leaning that way. I hope that answers. Mohammed says the LTV ratio is 42.3%. Is this within the REIT covenant?
Yeah, so the local biased property stocks typically have a LTV ratio around the 40% level. So that's not something that's too surprising. In terms of it being within the REIT covenant, there hasn't been any specific highlights of them losing their REIT status because of it. Therefore, it's not a risk factor at this point. The only thing that they did negotiate was their interest cover covenant, but they did speak about it in quite detail in their last update. And at this point, it hasn't materialized as a big enough risk, for a material risk at this point. But we still keep a keen eye on it. So at this point, we would imagine that it is within that REIT covenant because they haven't highlighted any risk of losing their REIT status. Typically, if something like that has the potential to happen, as you would have seen with Fortress, I think about a year ago, they make it very clear to the investor that this is the potential thing to happen in relation to their REIT status and any of their REIT covenants, to make us all very aware of it and not surprised by any removal of their REIT status. But at this point for Redefine, it's not a factor. Those local listed property stocks typically trade around that 40 or so percent LTV.
Thanks, Fisa. Right, guys, it's 12 o'clock. We're out of time. It's been a good discussion. I think to highlight, Fisa values are Redefine at an intrinsic value that's much lower than the possible price target that he has. So he says it's got some upside and some legs to run. We've discussed the reasons why and why you shouldn't consider it for your portfolio. That's entirely up to you. And we'll be back next week discussing Impala with, I think it's Marnus. It's going to be chatting to us about Impala. And we'll give you an update about that. Look out for that invitation. But same time, same place next week. Thank you for joining us today. And Fiso, thank you for sharing your knowledge with us. Sean, thanks for looking at the technicals for us. And I agree. I mean, the stock around 420 is at a very, very strong support. And it's supported by Fiso's view that at that price, it's very, very cheap. So keep an eye on Redefine for inclusion into a portfolio. Have a great Thursday, guys. Cheers.
Thank you. Cheers.